What I see is people fail at real estate development because they don't have a solid process and they don't know how to financially model it to success. Hey everybody, Greg Barron here, professor of real estate. Thanks for joining me today. We're going to talk about subdivision development today. It just so happens that one of my companies has approximately 4,000 or 5,000 lots under design or construction, and we have cut our teeth on how to step by step through developing successful lot development, subdivisions. So today I'm going to give you several points that I think you'll be able to utilize, and if you'll stay all the way to the end, we will get to the point of financial modeling, and then we'll cut it off and we'll have part 2 next week, so be sure and come back and see how we actually talk about absorption and the financial component. But today I'm going to line you out on the most important things that we use from a 20,000 foot view to get you started. So just like anything else, the first thing is locating the deal. You have to have a general idea of what it is that you want to do. A lot of times we're dealing with 1,000 acres and cutting it up into parcels. We'll take 50-acre parcels. They just come in all shapes and sizes. Depending upon your ability, both financially and otherwise, if you have to raise capital, bring on investors, you have to determine, okay, what size do I really want? How do you do that? Well, you got to be in the game for one thing. There's kind of 3 components to it. We either sniff around, do a lot of windshield time to find that demographic area that we want to be in. We've studied the growth patterns. We have a general idea. Normally, that's around the area that you're familiar with. Number 2 is we always want to have those broker relationships that we know that they're out there and they're going to bring them to us. So once you've determined the size of the development that you want to try to pursue, then you need to start sniffing around and locating the deal. And that usually takes several forms. If you're like us, real estate agents and brokers bring you deals for you to look at and give you an initial thumbs up or thumbs down based upon location, demographics, and so on and so forth. The other thing that we do is we have a lot of network of people out there that bring us deals that want to participate. They know that we're in the game, therefore they bring them to us. They understand that we can do all the things to bring this thing to fruition. So we have a vast network of people that continually bring us projects. So locating the deal is one of the most important things. You're going to have to look at a lot of turkeys before you get on the one that makes sense to you. It takes networks, it takes real estate agents, it takes brokers. A lot of these things are off market, but you've got to be in the game to even receive these kind of projects that might come on the line. So sniffing out the deal and locating it is one of the most important parts, and it's a lot of hard ground to plow. Once we've determined the deal that we want to pursue, then we deep dive a little bit further, and we determine price points of any of the lots available around it, absorption rates. We also naturally determine what the overall price per square foot or per acre in the case of larger tracts are concerned. But the most important part of number 2 is determining the actual need. That takes research on your part before you really start the next step to spend any valuable money. So after you've located the deal, and then after you've done the forensics to determine the need, then is the time to try to tie up the property with the letter of intent. So as you submit your letter of intent, you really want to gauge just how long it's going to take you to do the rest of the forensic exercise to determine utility districts, available utilities to the site, adequacy of those utilities. Then you're going to have a host of other things to flesh out. And sometimes it takes 60 days, sometimes it takes 90 days in an LOI or feasibility period, and sometimes it's taken upwards of 9 to 12 months on the bigger projects we have. Each project is a little bit different, but one thing you don't want to do in your LOI is cut short this feasibility period to where you don't have an opportunity to fully perform the forensics that you need to do. Now, in speaking a little bit to an LOI, if you'll check the link below, we're going to have a sample LOI on something that I've submitted in the past. It's just a template. These LOIs are obviously project specific, but it might give you some examples to follow in the future. We've used a ton of them, and it mainly points out a non-commitment period for feasibility prior to your earnest money that you will have to put up going hard. So a few of the things that you need to do in your LOI, you need to speak to the feasibility period, the closing period, and any transactional extensions that you might have to have. You're going to need an attorney to help you develop an LOI unless you've done them over and over again, because you don't want to get tripped up and all of a sudden you've wasted your earnest money and a lot of feasibility and due diligence money in the process. Now, it's really important, once this letter of intent is executed, your start date for feasibility and due diligence analysis begins. So you're going to have a process to step through at this point that runs pretty quickly, because most of the time that seller has very little patience past that point to grant you extensions if he finds out that you're dragging your feet on your own due diligence. So here's some things that I would suggest to you that you do. This is a real life project that we've had in our portfolio for a while. I won't tell you how it ends up because I want you to come back on part 2 as you discover if it's a go or a no-go. But here's some steps that you need to take. So before I get into the actual value creation of master planning, which is very important, let me just give you a bird's eye view of this property that we're looking at. This one happens to be on a side canal off of a lake, so we'll have lake lots, and it also wraps around tee boxes and fairways of an existing golf course. So you can see that it's tucked into this little cove. It's not a big deal. It's about 11 acres, and we anticipate that we could carve out about 21 lots. So how are we going to do that, and what's the process? So remember, this is an actual project, and what you're looking at right now is a 21 lot subdivision development with roads and utilities up against a golf course and on a lake. It's a little unique. It was very interesting to us. And so at this point, we have hired an engineer to start several iterations of what I call the value creation, or creating efficiency in lots, to determine how many lots that we can partition out of this 11-acre parcel. And then we have to determine what size lots demographically are going to fit the profile of the surrounding community. So again, we're in the feasibility period. So we're not starting on engineering documents. We just want to pass this off to a civil engineer, which happens to be us because we have that in-house, to do multiple iterations to determine the highest and best use of this piece of property. That's generally what a civil engineer does. If they're masterful at it, they will be able to work with you to create value in the form of potential sales and use for that property. So as you can see from this one, it's not a big deal. I will tell you that the ultimate price point of this one is ultimately needs to pan out to around a $7 or $8 million deal, and I'm going to show you in a later video how we get there. So this particular iteration is about number 7 or 8 after we have shifted, we've determined lot size, we have done a lot of calculations on this, and we finally figured out in our feasibility study that this is the layout size that we want that will bring us the highest and best return, we think, we don't know yet, on our development. So the next step that I do after I have determined this is the master plan that I think will bring me the greatest returns, I then develop what's called an estimate of probable cost, and my civil engineer helps me to define these costs more than anybody else in the process. And as you can see here, an estimate of probable costs from your engineer will include a wide range of cost estimates. And at this point in time, you have not engaged for full construction documents. You don't know that it'll work yet until you get these estimates first before you do your financial model. But these should include items like excavation, erosion control, paving, sanitary sewer, water, signage, and then totaled out. There will be other costs as well that your engineer will be able to help you determine. They might be you're in certain utility districts, permits, fees, those sort of things Have them help you accumulate all those costs. We call them hard and soft costs that go into the project. Before doing any financial modeling, you want to have as many data points as you can to be able to insert into a system like Excel or our ProformaPlus software to be able to do a really tight original analysis on whether this is a viable project, and most importantly, if it's going to satisfy your risk and reward return profile, the reason you're in the game in the first place. Now, this next step can be done prior to the previous steps, but it's important that you have a good idea of moving forward of your financing and carrying cost. Those costs are a commitment letter from a bank or even a phone call if you've got a great relationship with a couple of banks to try to get in the ballpark of just what your construction loan is going to be. They'll give you a term, they'll give you points, and they'll give you a general idea of what your percentage of sales they'll require to buy down the loan every month as you start selling. So this step I call capital stack and preliminary financing cost. So not only have I got my term sheet or at least an idea of what my interest carry for my construction loan is, but I also have my points. I also figure out my title insurance cost, any legal costs, which could be substantial if it's a sponsor investor type of deal. Now, the next component of the capital stack is to determine just what kind of investor-sponsor relationship you want to have. How much equity you're going to raise, and how much is going to be sponsored by you, and how much is going to be contributed as equity by your investors. You'll be able to determine your promote rate, your required internal rate of return, and of course you'll need to include the property taxes for the carrying costs throughout the life of the project until you're fully sold out. And at this time, you have a general idea of what kind of return, if you have investors, that you need to produce. Personally, on my deals, I want to have a minimum equity multiple of 1.4 for investors and about 1.6 to 1.7 for me coming out. My internal rate of return, it needs to be higher for a landlocked development deal, and many times I want it 25 to 30% or above at a minimum. So the last thing you want to do is insert some marketing and advertising costs that are part of soft costs because it is a component of sales. So as we finish off this part one, I want to remind you that we haven't done any financially modeling yet, but all the collection of this data and the steps that I've gone through are the first vital component before we go to step 2 next week, where we're really going to insert this data, and I'm going to show you how to determine absorption, interest carry, rate of return for your investors, and promote if you have any, and ultimately to determine if it's a go or a no-go based upon the original sales price. As always, if you enjoy the content, be sure and like and subscribe for me. Until next week, remember, educate, evaluate, so you can ultimately execute for your own personal wealth. We'll see you soon.